Everybody, welcome to Schwab Live Dailies, version of Liz Ann Live for June 15th, Monday. Bit of a crazy day in the markets today, a little bit of a turnaround, especially kind of given what we saw. The futures pointing to potentially a pretty negative morning. We did see that for about an hour or so. Then the markets came kind of roaring back and finished up around 50, 60 basis points in the S&P. So a bit of a turnaround Monday, if you will. But today's an interesting day because we have a preview of Liz Ann's mid-year update that we're going to be going in further depth on June 30th. So make sure that all of you participate in our June 30th special edition event that we're going to be hosting through Schwab Live Daily. And one of those editions that we will be hosting throughout the day will be another version of Liz Ann Live with myself and our special guest, as always, Liz Ann Sonders. Liz Ann, how are you today?
I'm fine, thank you, Joe. How are you? Welcome, everybody.
Welcome, everybody, and I'm doing well. Thank you for asking. You know what we're going to do, guys, real quick? Let's go through our disclosures, and then we will get through the article. All right, anything Liz Ann and I talk about today are really for informational and educational purposes only. Please do not take this to mean any investment advice. We'll be covering through some investment themes today, which I think are important, and that'll be partly because we got a big, meaty article here that I kind of want to at least introduce. So Liz Ann can point out some of the key points to it. And like I said, take notes today. Take really diligent notes because these are questions that you can bring to the table in 2 weeks when we really kind of dissect Liz Ann's mid-year review. So let's just kind of get right into it. Let's kick it off with really what we're starting with is stocks leading the economy. Where are we right now relative to what the economy is telling us? And one of the things that Liz Ann that I see right away, first things first is the bear market started on February 19th and ended on March 23rd. Is that right?
Assuming we don't retest and or go through the lows, given that the rally since the March 23rd low took us well into, official bull market territory, yeah, we can point to the end as a whopping 33-day bear market, and you can see how that contrasts with prior bear markets. By the way, this table is only bear markets that have had a recession associated with them, so that's why periods like 1987 are not on here, because it was a bear market absent a recession. So I wanted to point that out.
All right, well, let's do this because I think this is important. I know that you get asked this many times, and I apologize, but I'm going to ask it to you again. What constitutes a recession per se? Is it 2 declining quarters of GDP, or what is it?
No, it is not. It has never been that. And it's funny how often I hear from people, well, that's the classic definition or the popular definition, but it's never been the definition. The National Bureau of Economic Research, which is the official arbiters of recessions, and they've been using basically the same data methodology and have been the official arbiters of recessions since the late 1970s. And their definition is, quote, a significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Those last four metrics, by the way, are not coincidentally the four components of the index of coincident indicators, which is tied to GDP. Now, the declaration by the NBER that the peak in activity was in February was the fastest they've ever dated a recession. Not a big surprise. It was, the fact that we're in a recession was sort of a duh. And then what they typically do, which is they go back to the peak in economic activity and say, okay, that's when the expansion ended and the recession began, that's also important to remember, that the reason why it often seems odd that the market starts selling off when the data is still good is because recessions begin at the peak in economic activity. I think more interesting is going to be how and when the NBER decides to date the end of the recession, because I think we're going to be in recession type conditions even after the trough in economic activity. So I think it's going to take them a lot longer to declare the end than it did to declare the start.
So what does that look like then? I mean, I'm assuming, we can go back to our whole alphabet examples again, right? W's versus V's versus, I heard square roots, right? So, I mean, what does that look like in terms of the economy going forward if we say that the recession, is still going to be going on after we've hit the trough? Does that just mean expectations for growth have to be lower for longer?
I think we're, using letters, I think what we're likely to see is sort of rolling W's, kind of a wavy recovery where you have fits and starts, not necessarily as a function of the virus. I don't think we're going to shut the economy down again, but as we've seen in Florida just today, several bars have had to shut back down because of an increase in cases. So even if the government doesn't shut the economy down, it doesn't mean that the consumers might stop, going out and spending, and or businesses might opt to shut down. So, and I also think that right now we're seeing a lot of V-shaped recoveries in economic data, but remember, the first half of a W is a V.
That's right.
So, it's yet to be seen.
Okay, no, that makes sense. Well, the next slide you bring up here is on the GDP Now forecast, and I realize that this goes through, what is this, Q2?
This is for the second quarter. This is put out by Atlanta Fed. The blue chip consensus hasn't been updated as recently as the Atlanta Fed updated their GDP Now, but you can see, talking about a down 48% or so. That's quarter over quarter annualized rate. That's their estimate for second quarter. There are estimates that are better than that, but let's call that the consensus for now. They don't have an estimate published yet for the third quarter, but as a proxy for that, the Bloomberg consensus of economists is for the third quarter to see an increase of 20%. So that's one of the things I wanted to highlight in the mid-year, is that the law of a contraction in the economy based on a shutdown, where you basically go full stop, is such that from the bottom, which was such a compressed bottom, the percentage increases off that bottom are going to look huge. It's just
Right.
going to take a long time before we actually get back to prior levels.
That's true. Yeah, that's true. I mean, it's almost, when you think about the market has a 20% decrease. It needs 25% back to get back to break even. So if you have an even bigger contraction like this, it takes that much more
Yeah, down 50,
to
you
really
need
get
up
back.
100 to get back to
Absolutely.
even. So we can't get jaded by the size of some of these percentage increases. This is a situation where you have to also take kind of level into consideration, not just change.
And that's why sometimes it's really hard, because you see these flash numbers, right? You see the flash number. I mean, even going back to last week, where there was the unexpected, excuse me, 2 weeks ago, where you had the unexpected unemployment number came out, adding 2.5 million jobs, which we still kind of need to dig through that a little bit further, as we've seen. But you see a flash number like that, and the market reacts so quickly to that, as opposed to, well, what does it? What does an addition of 2.5 million mean when you take a step back and look at where we're coming from? I think
Right.
is what you're
Yep.
alluding to there. So,
Absolutely.
very good point. All right, money supply versus velocity. We talked about this one before, but I think it's important once again to address this, because just because you see more money in the economy doesn't mean it's always being put to work, does it?
Exactly. So this helps to explain why the market has rallied as sharply as it has, given not only the sheer amount of relief and liquidity provided by the combination of the Fed and Congress, Treasury Department, which accounts for this huge spike in money supply, but only with velocity does it tend to become an inflation problem. So aside from questions about the disconnect between the market and the economy, the one of the top questions I've been getting on client webcasts has been, isn't all this sort of money printing, liquidity provisions, all this so-called stimulus, it's not really stimulus, it's relief, isn't
Mhm.
this an inflation accident waiting to happen? Very unlikely, with velocity kind of still at the bottom here. So I think that helps to explain it. The money has to move into the economy via the lending channels and spending channels and pick up speed for it to become an inflation problem.
Maybe it's not an inflation problem, but would you be willing to consider the idea that it could be a problem with asset price inflation?
Oh yeah, we're getting plenty of inflation. It's just in
Sure.
asset prices, not the real economy. Same thing happened in the last cycle. We had plenty of asset inflation. We had very little real economy inflation. And that was part of the reason for subdued growth.
Yeah, no, absolutely. I think, and I do think that's important. We're going to talk about debt here in a moment, and when you consider that idea of, this also, to a certain extent touches on the idea of wealth distribution and how the inequality, because people that hold hard assets, homes, and they hold, positions in the stock market, they do get to see their values appreciate from some of the appreciation in the economy, whereas that's not distributed equally. So that, that
That's
becomes
right.
an issue
And,
as well too.
and Fed heads have sort of demurred when getting the question about whether their policies have exacerbated the wealth divide. And I think that's because they maybe can rightly say that that wasn't the goal of what they
Right.
did, but because of that asset inflation really having more of a beneficial impact on those holding the assets. You're absolutely right.
All right, so let's take a look at this weight of debt, and I think this is important because at some point, I know we always ask this question, well, when's too much debt, or when's enough's enough? But I think really what we want to be paying attention to is, what does it mean going forward? Not as, what is that current flash number? Because at some point that it just becomes a number, doesn't it? I mean, you just add a couple extra zeros, but what is the weight? What does that do going
So
forward for the
yeah,
economy?
people often ask me questions about this. This is the number sort of two topic of conversation aside from disconnect between the market and the economy is, what about all of this money printing and stimulus? Is it going to be inflationary, and what are the long-term implications of this debt bubble? And my answer is typically that because of the unique status of the United States and its currency being the world's monetary standard and the global reserve currency, our ability to kind of print money by the central bank puts us in a different category than a lot of other nations. That doesn't mean debt doesn't matter. It just probably prevents it from becoming a moment in time crisis. What I've been saying is it's more of a crisis over time than it is a moment in time crisis. And that has to do with rising debt's impact on economic growth. And you could look at this in terms of government spending as a share of GDP. Similar data is what I show in the table, which is if you just look at three simple zones, low debt, kind of, medium, neutral, and then high debt, and we're clearly well in the high debt zone.
Sure.
If you look at history, and this goes back in the post-World War II era, you can see that across the spectrum of indicators, including inflation, you're just looking at lower growth and lower inflation in the high debt zone. So maybe you don't care about that, but that is a factor. And really, why I think it's a simmering crisis over time, not necessarily some implosion that's going to happen in a moment in time.
Well, it makes sense. I mean, when you kind of step away from investment, finance, and economic talk, and just, and think about it, and think about just daily consumerism. If you are riddled with debt, that doesn't allow you to invest, to
Right.
save, and do other things that you want. The,
That's
the
right.
the government is the exact same way. I mean, you can't fund building projects if you're constantly financing the debt, and
And
these are
remember,
real world
debt isn't
problems.
only a problem at the government level. It's less of a
Hmm.
problem among households, courtesy of the deleveraging that households did after the financial crisis. But non-financial corporate sector debt is massive. And I think there's an underestimation of the impact of that going forward, whether it's on the labor market and the potential for defaults and bankruptcies. So I think that is also a hindrance to economic growth.
Why take on more debt if a federal judge allows you to offer more shares open to the market? Well, we'll leave that one. We'll leave that one alone. But
We will
excuse
talk
me.
about that on the 30th.
That's a whole different one. Exactly. All right. Want to talk a little bit about what's going on with jobless claims. I found this one to be really interesting because I never would have thought about looking at the Apple routing request. But once again, this is why you have the show and not me, because you come up with these really cool topics. What is
Well,
this?
this, yeah,
What does
so
this one
this
mean here?
just, kind of helps to explain the market rally in a context other than, Fed providing tons of liquidity, don't fight the Fed kind of typical market
Mhm.
move. And this just shows the market's power and ability to look at just a shift in the data, that inflection points matter, even if in level terms, it's still a pretty dire economic environment. We're still looking at millions in terms of initial unemployment claims, but the peak in those claims happened to correspond about with the bottom in sort of mobility data. This particular chart just looks at Apple's routing requests for
Okay.
driving, but you could look at any form of mobility data. And it just kind of ties some of the short-term, really short-term leading indicators that are relevant in this environment, looking at whether people are kind of getting out and moving around, and it ties it to economic data.
Yeah, no, it's interesting. I got a couple questions here. I'll take one of them real fast because I think
Sure.
it kind of talks about some of the next couple slides we're going to show here. It says, Lizanne, what is your main difference when you talk about consumer-led growth in the economy versus investment-led growth in
Yeah,
the
so I
economy?
think we may be in the process of a secular shift from what has clearly been a consumer spending driven economy. Since the early 80s, consumer spending has become the most significant driver of economic growth. The pre-pandemic peak was just under 70% of GDP was driven by consumer spending. And of course, services, if you break the economy out into different sort of segments, services represented about 88% of the economy versus manufacturing's 12%. I just think it's not going to happen overnight, but I think we may be in the process of a shift away from such dominance in the economy by services and or consumer spending and more toward investment, whether it's technology investments, healthcare investments, infrastructure investments. I think that will grow in importance in economic growth and will have an economy less biased toward the services and consumer spending side.
Oh, I'm sorry, didn't even see that. Excuse me. All right, and I bring that up because we talk about consumer confidence being a big driver in the economy, and boy, it seems like consumers are starting to pick that confidence up again, aren't they?
Yeah, so you see in the past, heading into recessions, which are the gray bars, not surprisingly, we've seen consumer confidence, the present situation, sink. But typically, even in advance of recessions, you tend to also see expectations about the future. And the way they ask the question is looking ahead 6 months,
Mhm.
also sink. But we've seen consumer expectations stay relatively healthy in the face of this massive decline in the present situation index. This just tells you there's a disconnect right now between how consumers feel in the present environment, clearly terrible, but this is sort of an example of consumers believing that we've got a V-shaped recovery and jobs are coming back and we're going to be just fine. And I think this represents a potential risk. Look,
Mhm.
I hope the market is dead on accurate. I hope their expectations for the future being much, much rosier. I hope this is dead on accurate. I'm not a skeptic just to be a skeptic. The reality is I don't know. I hope that this optimism that has been building, seen in metrics like this and in the market, is accurate. That would be great.
Yeah, the optimism's been running a little rampant with some of the different trades that we've seen going on. We'll get to that momentarily because I want to spend a couple more minutes here just talking about the initial claims because wow, there sure is a disconnect. That kind of goes back to that Main Street versus Wall Street, but just how quickly we saw cumulative initial claims soaring, isn't it? Isn't that amazing?
Yeah, so we can look at weekly initial claims, and that's a key leading indicator. But if you look at the cumulative total of all
Mhm.
the claims, so if you add up all the weeks that we've had initial claims since the spike and since the recession, as we know now began, in only 4 months, we've hit more than 45 million initial claims on a cumulative basis. That we've never, first of all, we've never seen a number that high, and the fact that it occurred in only 4 months is further highlights the warp speed nature of what's been happening here, but also shows just how deep a hole that's been dug from which we have to climb.
I think it also speaks volumes of the fact that we could continue to see more. That this just could be, hopefully this is not the case, but it very well could be, second or third inning, and
Right,
in what could be even further layoffs as a lot of these furloughed
right.
temporary workers, find out that there might not be jobs to come back to as a lot of companies to a certain extent have seen productivity almost increase from people being at home. Maybe that's kind of changing. We've talked about this before, the secular landscape going forward in terms of, what does the workplace environment look like. So that'll be an interesting one to keep an eye on as
Yeah, and I
well.
think also, and I think it's the next chart. Yes, it is.
Mhm.
So I think this is also key to keep an eye on. This is continuing claims. So this is people who didn't just file for the first time, but remain on unemployment insurance. And this is key because this represents sort of is a picture of how long lasting the weakness is going to be. If millions of people sort of stay on unemployment insurance, meaning they haven't gotten either their jobs back or found another job. And it's come down a little bit, but clearly still historically off the charts.
Right. Yeah. And the moving average is moving in the wrong direction. Well, we just talked about the speculative nature. Now we're kind of moving into my wheelhouse a little bit here, talking
Mm-hmm.
about options speculation. And this is a pretty telling chart when I look at this one because there's a couple other times where I've seen this happen before, and wow, a lot of that, really the biggest move towards put call ratios towards the call side, right? Since 2000, when you saw everybody buying call options on these speculative tech companies that everybody thought was going to change the world. So it's really interesting because in the year 2000, at least you had a financial backdrop behind you that looked pretty good, and everybody just thought that it was going to continue forever. Now you're seeing a little bit different. You have that not such a rosy financial backdrop, but a lot of speculation that, wow, some of these companies that have been faring very poorly in the last couple of months could be really turning around. You see that with the call speculation, a lot of call buyers out there. You see that with a lot of the trading activity that's going on. We show this in the next chart here on the zombie companies, excuse me, the search trends, but also on some of these zombie companies here and how they're doing on the Russell. It just seems like people are reaching right now, doesn't it?
Yeah, it really is quite extraordinary. And I did notice the typo on the word moving. So my type A personality is freaking out a little bit. So the first thing I'm going to do when I get off is go to the editors and make that change. But yeah, you're certainly seeing in the put call ratio. You have to go back to 2000, the last time we saw that kind of speculative activity, but also you can go back to the chart you just
Mhm.
popped from, just in terms of the types of companies that are doing well. There's been a lot of attention on companies in bankruptcy that have gone parabolic. You're seeing it particularly in small cap indexes. So this looks at both the S&P and the Russell and looks at the relationship between zombie companies' performance and non-zombies or ex-zombies. So zombies are companies that aren't earning enough to even pay the interest on their debt, let alone fund other things, versus the non-zombies. In the case of the S&P, admittedly a higher quality index, the non-zombies are dramatically outperforming the zombies. It's the opposite in the case of the Russell 2000. So what's powered the Russell in this recent outperformance phase for small caps has been the lowest quality companies, the companies that are classified as zombies. That's another way to look at speculation in addition to things like the put call ratio.
So would that then kind of add credence to the idea of, maybe looking for the larger cap versus smaller cap in terms of portfolio allocation?
Yeah, I mean, small caps certainly have momentum going for them, and it's dominated now. Interestingly, the Russell 2000, the largest sector represented is the healthcare sector. So that's got, it's got that going for it. But the fundamentals broadly for small caps are just far inferior to large caps. I don't know that I would really press the overweight large cap bet at this point because of that momentum factor. But if you're a fundamental investor, it's hard to cheer for small caps because they just on just about every quality metric, they pale in comparison
Yeah, that makes a lot of sense.
broadly.
I want to get to a couple more questions here. This is from Pat in Massachusetts. Pat says, what's the likely impact on the market of the continued and possibly increased unemployment over the next year?
So, unemployment is one of the most lagging of indicators, whereas the stock market is a leading indicator. So, and I'm not suggesting that there's anything resembling normalcy in this environment, but for historical context, the best performance for the stock market has actually come when the unemployment rate is in its highest zones, not its lowest zones, because of that forward-looking discounting nature of the stock market. At economic troughs, when the stock market has typically already found its bottom and moved higher, the unemployment rate as a lagging indicator is typically still rising, not only high, but typically still rising. That's certainly the case in 2009. So to see the market move ahead of the turn in the unemployment rate is quite normal. Now, that doesn't mean that if the unemployment rate either goes significantly higher from here based on the Bureau of Labor Statistics figuring out its quote miscalculation error that they talked about that would have actually had the print be 16.3% unemployment, not 13.3, or if it continues to
Yeah.
move up against a consensus of it moving down, yeah, I think it could cause a sell-off in the market or at least some market volatility. But I wouldn't expect that the unemployment rate has to come down significantly for the market's rally to have sustainability, because that's just not in keeping with the relationship between a leading indicator and a lagging indicator.
That makes sense. All right. One more question. This comes from Gary in California. I'm going to sum it up a little bit because it's a long one. It's a good one, Gary, but it's a long one. And basically, it says, Lizanne, what do you think the Fed's unwind process will look like between the corporate bond purchases, between the corporate ETFs, and all the different Fed buying purchases that have occurred over the last year? What does that unwind
Well, first
process
of all,
look
I
like?
think it's well down the road, and the Fed has made that very, very clear. I think Powell's quote, and this was referencing when they would start raising rates, was we're not even thinking about raising rates. So he,
Right.
the double thinking, I think, was to make a point. And in many of these programs, although were announced a while ago, haven't even been implemented yet, let alone some of what they're adding, like today's additional detail around the purchases of individual corporate bonds. So I'm not suggesting we never have to worry about it. It's just not a near-term phenomenon. So it's hard at this point to say, what does the unwind look like? It probably happens in a number of phases. Can't even tell yet whether they'd be unlikely to unwind some of the unique programs this time or do it on the rate side. But I think that is so far down the road that although there's plenty of things to worry about in terms of market volatility and risk factors, that is not one of them.
One thing that, and I very seldomly ever use the word guarantee, but one thing that I would guarantee is they will be very measured in their speech along how they plan on unwinding that, because
Oh, yeah.
anytime that they've kind of deviated from that very measured speak, that's when we've seen some market volatility. And we've seen Chairman Powell very much wants to avoid that market volatility, doesn't he?
That is true.
All right, Lizanne. Well, I appreciate it. Hey, everybody, look, you got a nice, brief little taste of what this is going to be in 2 weeks. So make sure on June 30th you tune in. We have a full day event for Schwab Live Daily where Lizanne and I are really going to be going into depth about her mid-year review. So what you saw today, we'll expand on these topics quite a bit, give you an opportunity to ask more questions. You had some really good ones today, so I appreciate that as always. Lizanne, we appreciate you. Thank you so much.
Thank you. Thanks, everybody.
And to all of you, make sure you tune in tomorrow morning for Trader Talk, kicking it off at 10 a.m. Eastern and 7 a.m. out here on the West Coast. Thanks, everybody. Have a great one. Goodbye.